Ripple just closed a $200 million credit facility. Russia's largest exchange is launching an XRP native index in 55 hours, and the Federal Reserve gets a new chairman in 4 days. The XRP army has been waiting for the explosion, and the fuse is now visible from the chart. XRP army. Look at what is happening right now and tell me you are not seeing it. The candles are moving, the headlines are stacking, the institutional partnerships are landing, the regulatory milestones are clearing, the macro transitions are aligning, and we are sitting 4 days away from one of the most consequential central bank transitions in modern history, and 3 days away from the Senate Banking Committee markup of the Clarity Act that decides whether the most important crypto legislation in American history advances to the Senate floor. This is not a normal week. This is the week the patient holders have been positioning for since the consolidation began. By the end of this video, I'm going to walk you through every single development that landed in the last 24 hours, what each one means in the bigger picture, why the timing of all of them in the same window is structurally significant, and what the chart is telling you about what comes next. But this is the part almost nobody understands. Let me start with the headline that should be dominating crypto news tonight, but is barely registering on most of the coverage. Ripple Prime just closed a $200 million debt facility to expand its margin financing and lending capacity for institutional clients. Stop. Sit with that number. $200 million. This is not a press release. This is not a marketing announcement. This is a closed institutional credit facility signed by counterparties with real capital behind it, designed specifically to expand the lending and margin services that Ripple offers to institutional clients. Which means somewhere in the institutional capital allocation ecosystem, there are lenders who looked at Ripple's business model, looked at the regulatory positioning, looked at the institutional customer base, and decided that extending $200 million in credit was a sound business decision. That is not what people do for a company they think is dying. That is not what people do for a project they consider speculative. That is what people do for an institutional payments infrastructure provider whose business is scaling fast enough that capital needs to be deployed to support the growth. And it is not happening in isolation. Last year, Ripple acquired G Treasury and Hidden Road. The acquisition cycle has been consistent for over 12 months. The infrastructure stack is being built quietly, piece by piece, while the retail community is focused on the daily candle close. When do they stop? The answer is they do not stop. Because the institutional thesis Ripple is executing on requires the infrastructure to be in place before the legal certainty arrives. The Clarity Act is the legal certainty. The acquisitions and the credit facilities and the partnerships are the infrastructure that gets deployed the moment the legal certainty lands. And this is where the story becomes dangerous. Now let me bring in what Patrick, the White House crypto advisor, just posted, because it is one of the most direct public statements about the institutional banking dynamic that I have seen come out of the administration. Patrick wrote that he specifically requested the attendance of Rob Nichols, the CEO of the American Bankers Association, and other bank trade CEOs at a meeting the White House hosted back in February. The meeting was designed to resolve issues with the stablecoin framework. The bank CEOs refused to attend. In Patrick's words, the White House was apparently beneath them. And in his defense, paraphrasing his post, he would not want to have to defend what those bank CEOs did either. Brad Garlinghouse, the CEO of Ripple, just reposted that statement within minutes. That is not a coincidence. That is Brad publicly aligning Ripple with the White House's position against the bank lobby that has been trying to derail crypto legislation. The American Bankers Association has been urging bank CEOs to oppose stablecoin provisions ahead of Thursday's markup. Rob Nichols specifically authored that opposition letter, and the White House is now publicly calling out the same banking establishment for refusing to engage in good faith when the administration tried to address their concerns directly. Brad's riposte is the institutional industry's response. The crypto industry, led by Ripple, is no longer playing defense against bank lobby opposition. It is going on offense, publicly, with the White House behind it. Now here's where things get serious. That dynamic matters more than the surface read of the situation suggests, because for years, the bank lobby has had the upper hand in crypto legislative debates. They had the relationships in Washington, they had the campaign donations, they had the regulatory capture that made it easy for them to slow or shape every piece of crypto legislation that came through the system. That is changing. The Trump administration is publicly hostile to bank lobby opposition. Brad Garlinghouse is publicly reposting White House statements that call out specific banking executives. The crypto industry is funding political action committees with hundreds of millions of dollars that are aimed at any senator who blocks the Clarity Act. and the Senate Banking Committee Chairman Tim Scott has signaled that he is willing to use every procedural lever available to get this bill through committee with bipartisan support. The bank lobby is losing the political fight that they have won for the last 15 years. And the markup vote on Thursday is the public confirmation of that shift. And what happens next changes everything. Now, let me bring in the international dimension because this is the part the US focused coverage is completely missing. Russia's largest exchange, MOEX, the Moscow Exchange, is less than 55 hours away from the official debut of the MOEX Ripple Native Index. Read that again. A sovereign scale exchange in a major global economy is launching an XRP native index in the next 55 hours. That is not a small story. That is a major exchange in a non-US jurisdiction creating institutional-grade financial infrastructure around XRP specifically. The launch of a native index allows institutional investors in that market to gain exposure to XRP through regulated financial products without holding the underlying asset directly. It opens the door for pension funds, sovereign wealth funds, and institutional allocators in that region to deploy capital into XRP through the infrastructure they are already comfortable using. The MOEX launch is happening regardless of what the United States does on the Clarity Act this week. The global adoption of XRP as institutional infrastructure is not waiting for US legislative clarity. It is happening in parallel in the UK, in the EU, in Japan, in the UAE, and now in Russia. The question that the US-focused community needs to start asking is whether the US catches up to the global adoption curve before it gets left behind, because the rest of the world is not waiting. The MOEX listing is the latest example. There will be more. And every additional jurisdiction that integrates XRP into institutional financial products before the US does adds to the pressure on the US legislative process to deliver clarity quickly. But this is the part almost nobody is connecting. Now, let me address the broader macro environment because 3 days from now we have the markup, 4 days from now we have the Powell to Warsh Fed chair transition, and all of it is happening against the backdrop of one of the most consequential political weeks of the year. Jerome Powell, too late Powell, as Trump has been calling him, is leaving the Federal Reserve chairmanship in 4 days. Kevin Warsh takes the role. That transition is not a footnote. Powell's tenure was defined by the most aggressive monetary tightening cycle in 40 years, followed by a delayed response to changing inflation conditions that has frustrated the administration, frustrated risk-on investors, and frustrated the broader markets that have been waiting for a clearer signal on the direction of rate policy. Warsh comes into the role with a fundamentally different posture. He is widely understood to be more dovish on crypto. He is closer to the Trump administration's policy framework. And his first 90 days at the Fed are going to set the tone for how monetary policy interacts with the regulatory clarity that the Clarity Act is designed to provide. That combination, a new Fed chair aligned with the administration's policy direction and a new federal crypto law being signed within the same 60-day window, is the most favorable monetary and regulatory alignment that the digital asset industry has ever experienced in the United States. Not even close. The previous cycle did not have it. The cycle before that did not have it. This cycle has it. And we are sitting at $1.45 on XRP, while all of that aligns simultaneously. Now here's where things get serious for the markup vote. 3 days from now, the Senate Banking Committee meets to vote on the markup of the Clarity Act. The committee has 24 members, 13 Republicans, 11 Democrats. Chairman Tim Scott needs all 13 Republicans plus at least one Democrat to clear the bill out of committee with bipartisan support. 2 Democrats are the realistic crossover targets based on prior public positioning: Senator Angela Alsobrooks, Senator Ruben Gallego. Both have indicated openness to the bill based on the compromise framework that was negotiated between Brian Armstrong, Treasury Secretary Scott Bessent, and the Tillis-Alsobrooks compromise on stablecoin yield restrictions. The vote count going into Thursday is closer than the coverage suggests. The political environment is more aligned than it has been at any prior point in this bill's 2-year legislative history. And the institutional capital that has been waiting for committee passage is positioned to react the moment the vote is announced. Place your bets. That is what the community is saying about Thursday. And it is appropriate, because Thursday is the trigger event that releases the next phase of the cycle, past the markup, and the chart breaks $1.50 and runs to $1.70 to $2 on the cup and handle pattern. Postpone the markup and we drop back into the $1.34 to $1.40 zone for another round of consolidation before the next catalyst window. Both outcomes are tradable. Both outcomes are part of the structural setup. Neither outcome breaks the thesis. And this is where the story becomes dangerous to dismiss. Now, let me show you what is happening on the chart while all of this is unfolding behind the scenes. XRP is at $1.45. We are once again at the top of the 4-month consolidation channel that started in late January. We have tested the $1.50 resistance level multiple times. Each time we have either broken through briefly or bounced back into the range. Look at the structural pattern. April 17th, we hit $1.50, faded back to $1.34. May 10th, we are back at $1.47 with a different setup behind us. The double top formation at $1.50 is real, and it deserves to be respected. There is a meaningful probability that we test the lower boundary again before the next leg up confirms. But here is the part the chart-only analysts are missing. The structural pattern that has been building for 4 months is not a distribution pattern. It is an accumulation pattern. Each test of the upper boundary has seen institutional absorption at the highs. Each test of the lower boundary has seen institutional bids at the lows. The volatility is compressing into a tighter range as we approach the breakout point. That is the textbook structure that precedes a major directional move. The longer the consolidation, the larger the eventual breakout. And 4 months of compression at this tightness, against the backdrop of the catalysts that are landing in the same window, is the most compressed setup XRP has produced since the cycle began. The whales know this. They have been buying through April when retail was selling. They have been adding through May when retail has been frustrated. They have been positioned through every single test of the upper and lower boundaries. And when the breakout confirms, they are not going to be the ones chasing the chart at higher prices. They are going to be the ones who are already positioned at the prices we are looking at right now. Now, here's where things get serious for the patient holder, because when an institutional credit facility, a sovereign exchange listing, and a Federal Reserve transition land in the same week as the most important crypto vote in American history, the question is no longer whether XRP explodes. The question is who is positioned when it does. Let me show you what is also happening in the broader market because the context matters. Bitcoin is moving back toward $100,000. Other major altcoins are participating. CRO is up 7%. ONDO is recovering after a rough stretch. The memcoin space is showing pockets of activity. The overall market is starting to wake up after months of suppression. That broader market awakening matters for XRP specifically because XRP has not decoupled from Bitcoin yet. When Bitcoin moves, XRP gets pulled higher, and Bitcoin is moving. The structural setup across the entire crypto market is starting to release the energy that has been compressed for months. The question is not whether the market moves. The market is moving. The question is which assets benefit the most from the move when it accelerates. And the answer to that question is determined by the catalysts each asset has lined up. XRP has more catalysts in the next 90 days than any other major asset in the market right now. Committee passage, Senate floor vote, presidential signature, Fed chair transition, Russian exchange listing, Ripple Prime institutional credit facility deployment, the first major U.S. bank announcement that follows Clarity Act passage, the first DTCC tokenized settlement that routes through XRP rails. Each one of those events is a directional catalyst. Together, they create the kind of cumulative momentum that produces the asymmetric moves that holders of this asset have been positioning for during the consolidation phase. And what happens next changes everything for global positioning. Let me also bring in something that connects directly to the institutional environment we are operating in. Michael Saylor, Daddy Saylor as the community calls him, just bought another 535 Bitcoin for $43 million at an average price of $80,000 per Bitcoin. Strategy now holds 118,000 Bitcoin total, worth approximately $61 billion at current prices, with a cost basis around $75,000 per Bitcoin. What that tells you is that the largest corporate Bitcoin treasury in the world is still aggressively buying at current prices. The institutional thesis that drove the original strategy is still being executed. The macro and regulatory environment that the strategy team is reading is favorable enough that they are willing to continue deploying capital at $80,000 per Bitcoin. That is the institutional read on the current market. They are buying, they are not waiting for confirmation, they are positioned, and when the broader market eventually confirms what the institutional players have already concluded, the prices retail holders are looking at today are going to look very different in hindsight. If Saylor is buying Bitcoin at $80,000 with a $61 billion treasury commitment, what does that tell you about how the institutional players who are tracking the XRP catalyst calendar are positioning right now? But this is the part almost nobody is sitting with. The pattern is the same across every major asset class. The institutional players are deploying capital into the assets where the structural thesis is intact, where the catalysts are calendared, and where the supply dynamics favor patient holders. The retail community is watching the daily candle close and feeling either bored or frustrated depending on the price action of the last 48 hours. That gap between institutional time horizons and retail time horizons is the entire mechanism by which institutional players accumulate before retail confirms. The boring months are when the structural positioning happens. The exciting months are when the chart reflects the positioning that was completed during the boring months. If you are holding XRP through the consolidation, you are not holding through nothing. You are holding through the structural accumulation phase. The whales are not selling at these prices. The institutional credit facilities are not getting unwound. The international exchange listings are not getting canceled. The legislative calendar is not getting delayed indefinitely. The Fed chair transition is not getting rescheduled. All of that is moving forward on a confirmed timeline. The only variable that is moving sideways right now is the price chart. And the price chart is the lagging indicator, not the leading indicator. And this is where the story becomes dangerous to ignore. Let me close with the bigger picture, because I want every XRP holder watching this to understand exactly where we are in the cycle and exactly what is in front of us. We are 3 days away from the markup vote that determines whether the Clarity Act advances to the Senate floor. We are 4 days away from the Fed chair transition that changes the monetary policy direction for the next several years. We are 55 hours away from a Russian sovereign exchange launching an XRP native index. We have a $200 million institutional credit facility that just closed at Ripple Prime. We have Brad Garlinghouse publicly aligning with the White House against the bank lobby that has been trying to derail crypto legislation. We have Michael Saylor adding 535 Bitcoin at $80,000. We have Bitcoin moving back toward $100,000. We have altcoins starting to participate. We have the global financial system beginning the most significant infrastructure transition since the 1970s. And we have XRP sitting at $1.45 with the tightest consolidation structure since the cycle began. This is not a normal week. This is the week the structural compression begins to release. Whether it releases on Thursday with a clean markup vote, or whether it releases over the next 30 days as the Senate floor vote schedule is confirmed and the catalysts continue to land, the direction is the same. The structural setup is the same. The institutional positioning is the same. The patient holder is positioned. The institutional players are positioned. The legislative calendar is in motion. The macro environment is shifting. The global adoption curve is accelerating. The chart is telling you that the compression cannot continue indefinitely. Now here's where things get serious for the next 72 hours. What I am watching specifically over the next 72 hours is the political math going into Thursday's vote. Whether Senator Kennedy commits publicly, whether Senator Alsobrooks and Senator Gallego confirm their support on the record, whether the bipartisan margin clears 15-9 or whether it stalls at 13-11, whether the ethics provisions get resolved before the vote or get carried into the floor debate. I am watching the macro data prints. Any inflation surprise, any statement from Kevin Warsh as he prepares to take the Fed chair role, any commentary from Trump or Treasury Secretary Bessent on the trade situation or the Iran negotiations. I am watching the institutional capital flows, the ETF data from the last 48 hours, the whale wallet movements from sentiment. The exchange balance changes that signal whether institutional buying is continuing or pausing during this window. And I am watching the chart, whether we break $1.50 cleanly into the cup and handle target range, or whether we double top here and fade back to the $1.34 to $1.40 zone before the next leg confirms. Every one of those data points moves the probability weighting on the catalysts. Every one of them informs the positioning decisions that the patient holder is making during this exact window. The compression is releasing. The question is the path it takes from here. And this is where the story becomes dangerous to oversimplify. I want to be honest with you about one more thing before we close. The XRP community has been through a lot. 5 years of legal uncertainty during the SEC lawsuit, months of sideways price action while the institutional thesis was being assembled behind the scenes, skepticism from family and friends who do not understand what is being built, the frustration of watching other assets pump while XRP held steady. All of that was the price of the position, and the position was not free. It cost patience, it cost conviction, it cost the willingness to hold through periods where the chart did not reward the holding. But what is in front of us now is not the same conditions you have been holding through. The catalysts are calendared, the institutional infrastructure is deployed, the political environment has shifted, the macro alignment is in place, The global adoption is accelerating. If you have been holding XRP through everything that came before this moment, you are not holding through the same uncertainty anymore. You are holding into the structural setup that the institutional players have been positioning for in parallel. That positioning is not visible on the chart. It is visible in the institutional credit facilities, the sovereign exchange listings, the legislative trajectory, the regulatory alignment, the corporate balance sheet additions, the global jurisdictional approvals, and the catalysts that are now arriving in clustered waves rather than isolated announcements. The structural picture has changed. The patient holder is positioned for the change, and the next 72 hours is the first major release window in the catalyst sequence that defines the next 90 days. One last note on positioning. If you are fully positioned and you have been holding through the consolidation, your job is to hold. Do not get shaken out by a potential dip back to $1.34. Do not panic sell if the markup vote produces unexpected drama. Do not let the noise of the next 3 days separate you from the structural position you have been building for months. If you have dry powder and you are looking for entries, the next 72 hours is a meaningful window. The dip into the $1.34 to $1.40 zone, if it materializes, is the kind of accumulation opportunity that institutional players are also positioning for. Dollar cost averaging into structural compression at the top of a 4-month range is one of the highest probability setups in this entire cycle. If you are completely out of position and you are watching from the sidelines, the question is whether you want to enter before the markup vote or after. Entering before means you are positioned for the release scenario if Thursday produces a clean bipartisan vote. Entering after means you are positioned for the institutional buying that follows the catalyst confirmation regardless of the immediate price reaction. There is no perfect entry. There is the entry that matches your time horizon, your risk tolerance, and your conviction in the structural thesis. That is the framework, not a price target, not a candle pattern. The structural conviction underneath the position. The XRP holders who are going to look back at this period clearly are the ones who understood that the consolidation was the structural setup, the catalysts were the release mechanism, and the patience was the prerequisite for capturing the asymmetric upside that follows the compression. Fuses don't make noise, explosions do, and by the time the explosion gets covered by the financial press, the people who watch the fuse will already be in a different conversation. XRP Army. The chart is moving, the headlines are stacking, the catalysts are landing, the political environment is shifting, the institutional positioning is happening in real time, and we are sitting in the most compressed structural setup the asset has produced since the cycle began. What are you going to do about it? Drop your positioning decision in the comments. Are you fully in dollar cost averaging or waiting for the markup vote to confirm? Let's see what this community is doing during this exact window. Smash the like button if this video helped you connect the dots that the surface level coverage of the last 24 hours has been missing. Subscribe and hit the bell, because when the markup vote happens on Thursday, when the Fed chair transition lands on Friday, when the MOEX index goes live in 55 hours, and when the next major institutional announcement breaks, my breakdown drops within hours of each event. I am all in. The thesis is intact. The setup is the tightest it has ever been. And the explosion is no longer a question of if, it is a question of when. Peace.